Thank you very much, Fred. Well, actually, I went to Latvia the first time in 1974 in the deep Soviet times. So I maintain a special affection for Latvia. And it's a great pleasure for me to present Valdis Dombrovskis to you, because I think that Prime Minister Dombrovskis has done an extraordinary job under very difficult circumstances in Latvia. Valdis Dombrovskis has been Prime Minister since March 2009, and his training is in physics, mathematics, and economics in Riga, Mainz in Germany, and also at the University of Maryland. He has worked previously in the Bank of Latvia. Already in 2002, he became Minister of Finance for 2 years. And he's one of the leaders of the New Era party, which stands out for free market policies and anti-corruption policies. In recent years before the crisis, Mr. Dombrovskis was member of the European Parliament, so he was out of Latvian politics during the worst overheating. And of course, the big question today is, how do you manage to get through this kind of crisis, the worst overheating in Europe? And as we'll discuss later, I think that we can say that the Latvian financial crisis is almost over now. Thank you. The floor is yours.
Well, ladies and gentlemen, it's a great honor for me to address such a prominent audience here in Peterson Institute. Thank you very much for your invitation. And so our today's topic is how did Latvia manage through the financial and economic crisis. So before going to this part on actually how we did we deal with the crisis, it's worth mentioning in a couple of words how did we get into crisis. And I would say after Latvia joined the EU in May 2004, there was lots of optimism about the future of economy. There was a period of strong growth. We had experienced a period of strong growth already several years before, with growth rates being somewhere between 5 and 7% annually. And after joining the EU, economic growth accelerated, and in fact in some years we enjoyed double-digit economic growth, reaching up to 12% annually. But then also the large economic imbalances accumulated during this time. Inflation also reached double digits, after having been between 1.9 and 2.9% inflation for 5 years before we were joining the EU. After we joined the EU, it was going up 6%, 8%, top was something 11 or 12%, and one of the quarters was even 15% quarterly data. So there was large inflation, and also our current account deficit, which reached 22.5% of GDP in 2007. Well, this is something almost unprecedented. That kind of levels of the current account deficits, 22.5% of GDP, it's huge. But to being able to run such a large current account deficit, you need someone to finance. And there we actually are coming into a picture which was to the extent similar with economic developments in the world. However, Latvia was much more worse than the world on average. We had the same issues with easy credit flows, real estate bubbles, construction booms. We experienced exactly kind of problems US, for example, had experienced just to the much more dramatic scale. For example, if US real estate market was down 1/3 from the peak values, so in our market in some segments was down afterwards 2/3 from the peak values. So imbalances were in fact huge. And one of the points which was triggering this huge imbalance was easy accessibility of credits, and in fact amount of credit in economy doubled during the years 2005, 2006. During 2 years' time, amount of credit which we had in economy doubled. Just to get a perspective of the credit expansion we had had. Lots of this was associated with easy lending policy of the Swedish banks, which were dominating the Latvia's banking sector, but also it means that there was clearly not sufficient legislative framework put in place from the point of view of government. Moreover, even when we had a double-digit economic growth, our government budget was not balanced, and government was interpreting very easily the Maastricht criteria rules, which is often interpreted not only in Latvia but in also Eurozone countries, that budget deficit should not exceed 3% of GDP. So you have a double-digit economic growth and government saying, well, our budget deficit is below 3% of GDP, what do you want from us? Whereas what Maastricht criteria says in reality is that budget has to be balanced during the economic cycle. And then during the times of stagnation or recession, budget deficit should not exceed 3% of GDP. In any case, we had this very easy bank credit policy, and then some restrictions were introduced in spring 2007 when it was effectively already too late. When there were some quantitative limits how much of the collateral value you can lend, there were some limits introduced that you can only loan according to the official income data, and so on and so on. But unfortunately, by that time, it was already too late, and also the policy, it was some politicians at that time were saying that we shouldn't really bother too much about those economic imbalances. It's more like pedal-to-metal policy. Now we have to give full gas, and unfortunately, that's where we ended. So once the global financial crisis started first, it also affected Latvia in a sense of restricted credit, and more particularly in a case of Parex Bank. It was our largest independent commercial bank, which is one of the top 3 banks, which both due to global financial crisis and mismanagement by former owners run into problems, so we had to nationalize this bank. And at this stage, basically, government did not have other choice than to apply for IMF for international loan package, because all in all, amount of direct finance which we put in a Parex Bank amounted to 4.9% of our GDP, and there were like some additional 2.6% of GDP in guarantees. So really, we were talking about substantial amounts of money. So eventually, at the end of 2008, this international loan package was prepared, financed by IMF, European Commission, and by bilateral loans from several European countries, mainly Nordic countries, but also some Central Central European countries. So as we know, all know, IMF, it's mostly fiscal, so it means that one of the first and important preconditions was to address the budget deficit, and during the 2009 budget amendments and 2010 budget, we did a fiscal consolidation of more than 10% of GDP. And a year ago, there was lots of doubt. Is this reasonable? Is this possible? There were lots of talks about possible devaluation of our currency Lats, which is effectively pegged to euro, and really doubts if this international loan package could continue in the current form. Exactly a year ago, we had speculative attacks on Lats, and also had to make the first round of budget cuts for half of the year. Budgetary reductions were amounting to more than 4% of the GDP. So then we had to go through another round in 2010 budget. And now if you look at those macroeconomic data, the agreement with international loan lenders is budget deficits of 10% last year, 8.5% this year, 6% next year, and 3% in 2012 in order to meet Maastricht criteria and being able to join the Eurozone in January 1st, 2014. Last year's actual data was 9% of GDP, so it was 1% of GDP better than targeted. Also, I would say we are now well on track with meeting our this year's budget deficit target and starting to prepare next year's budget. Then what was important to implement those huge fiscal adjustments, because just to give some figures, for example, our budget institutions' average wages in the first quarter of this year were down 25% to compare with 2008 average. Our ministries, the central apparatus of the ministries, was downsized on average by 30%, 30. And a number of different kind of agencies was reduced by half. So really those fiscal adjustments we were doing were very significant. And in this sense we had to concentrate on not only cutting budget but also on structural reforms in several fields. I will go into a little bit more detail later. Then we had to do something also about stimulating economy, because this fiscal consolidation package was basically acting as a large fiscal anti-stimulus during the recession. And third, very important direction was to present social stability while going through this huge fiscal consolidation. So on structural reforms, so to say, overarching priority is to restore the competitiveness, and this is having two dimensions. In the short term, it's a question about improving Latvia's credit ratings and improving access to finance to our enterprises. In the longer perspective, it's a question about sustainability of our economy. Then there were several fields which we took for structural reforms, like public administration, health, and education. As regards public administration, I already mentioned this very substantial downsizing and streamlining we had done. With health and education, certainly things were more difficult because people typically do not object if you reduce number of bureaucrats, but once you start to reduce number of teachers or schools or hospitals, that certainly gets quite different attention. But there I must say all the principles of the structural reforms we had been implementing in those sectors were known, in fact, from 1990s. There was a plan called Master Plan on Optimization of Hospitals Network, and in last year we in fact reduced number of hospitals from 49 to 24, so basically halved. There was known principle in education, which is money follows pupils, which would also mean downsizing of school network, improving pupils to teacher ratio. But unfortunately, during the boom years, those reforms were too politically unpopular to be actually implemented. So what we had to do those reforms in accelerated pace during the recession. And what I like to say to this respect is that reform starts where the money ends. So once money ended, we had to start reforms. Luckily, the principles were known, so we did not have to invent those reforms hastily. They were well prepared, well documented. There were studies done together with the World Bank and so on and so on. So basically, we had to take them off the shelf and implement, which was also done. As I said, number of hospitals, for example, was reduced by half. So we downsized or reorganized some 100 schools as of the September 1st of this year. So also in this respect, there were huge efforts to do with those structural reforms. Second important moment was to ensure some kind of economic stimulus when our fiscal policy acts as anti-stimulus. And so pretty much only serious means we had for this were financing from European funds, structural funds, cohesion fund. So what we had done, we had accelerated the absorption of EU funds and also reallocated them quite substantially to some social issues, which I'll talk later, but also to support of entrepreneurship, including high value added programs, to support of export-oriented industries, and in this way trying to stimulate not only just to stimulate economy, but also shift economy from the way it was operating first, driven by domestic demand, cheap credit, real estate bubble, and so much more towards industrial production and export-oriented sectors. In this, I would say we were not very original. There are quite a few countries which discuss necessity to stimulate exports and see this as a way out of the recession. But in our case, strategy seemed to have been working. First quarter of this year, we finally, after 8 quarters of recession, get economic growth, quarter on quarter plus 0.3, which is of course small, but at least it's finally growth and not recession. But if you look at the structure of economies, and for example, industrial production year on year is up 7.4%. Exports is up 10%, so really we see that not only we are coming out of the recession, but we are also changing the structure of economy, which is much more sustainable than it was previously. And third, very important factor which we had to deal with to ensure social stability while doing all this fiscal adjustment, because not only it affected all the fields previously mentioned, it also affected social policy with reduction of social benefits, in fact with cuts in pensions, which then later was, however, deemed anti-constitutional by constitutional courts, so we reinstated those. But in any case, so social stability was a very important matter. And in this regard, in a cooperation with World Bank, we introduced what we call minimum social safety network, which would improve some targeted social support to exactly those parts of the society which needs the most during this crisis. So lots of EU social fund resources were devoted to tackling unemployment problem. We had introduced a large temporary works program, which was actually tens of thousands of people were using it. We prolonged unemployed benefits for a period of payment of unemployed benefits. We increased guaranteed minimum income benefit, which is a benefit you get once you stop receiving unemployed benefit. We improved accessibility of healthcare and medicines to poor people. So it was really very important that there was this minimum social safety network, which on one hand was really helping people to go through recession, and also signaling that while doing all those cuts, government and tax raises not least, government is still taking care of the most vulnerable parts of society. And I think that was important part which helped to ensure social stability. Another was social dialogue. We created what we call reform management group together with representatives of employers organizations, with trade unions, with local government unions, where we were preparing the proposals for 2009 budget amendments, for 2010 budget, and in fact those most painful 2009 budget amendments were done according to the agreement we reached with employers, trade unions, and local governments. Not that they wanted to know about this agreement later, but luckily it was written, so then, since it was not a popular agreement, there were different kind of excuses as, yes, we agreed, but not really. But in any case, at least we kind of had social partners on board, and that was also very important if we wanted to maintain social stability. So those are basically three main aspects of our government's work during the last year, which was a fiscal consolidation, structural reform, economic stimulus to the extent we could afford it, and social safety network to ensure social stability. And this combination seemed to have worked. We now, while still having a large budget deficit, we reduced it to more or less manageable levels. And I would say now we are pretty much dependent on what will happen in the world economy, given our export-oriented strategy for recovery. Should the Eurozone troubles lead to double deep recession, of course that would will affect seriously Latvia. Should Europe continue to also move out of the recession and external economic environment for us would be favorable, I would say we are also well on path to go out of the recession and to have much more sustainable economies than we had before this crisis. And then, while a year ago and more than a year ago, Latvia was always on screen as the worst affected country by crisis, which could trigger problems for the whole northern European region. So now, well, this honor, so to say, is taken over by Greece, which is now seen as a most affected country by the crisis. But in fact, there are quite important lessons also for Greece to learn. Because in case of Latvia, this path of internal devaluation was new. Many had doubts that could work, and there were debate, which at least theoretically was valid. There's always possible to debate another option, which would be devaluation. In case of Greece and Eurozone countries, as long as we want to maintain the credibility of euro and stability of euro, devaluation is not an option. So the only option on table for Greece, for Spain, for some other Eurozone countries is internal devaluation, and that's what they are now also starting to do and starting to go through. Well, I'll probably stop here. Thank you very much for your attention, and I will be glad to answer your questions and comments. Thank you.